Hi everyone. With Sam, we have had a very interesting time after he reached out a long while ago, after basically the last Money Symposium. We finally kind of got to look at some things together a bit more in detail this fall, late this fall really, and it was quite exciting for us to collaborate on balance sheets. I guess we both love them. And this is basically the thing that we came up with. So Sam is going to introduce briefly the kind of idea and the intellectual inspiration for this, and then we're going to go into it in more detail.
Yeah, thank you. Yeah, I just wanted to where did my PowerPoint window go? Oh, here it is. I just wanted to, Lord, come on, computer. There we go. Just wanted to give a bit of an origin story for this. What we're going to be showing you today, and Sasha's going to turn this into a bit of a game, so I'm not going to show you too much about it right now. But a balance sheet accounting calculator that we've created together that answers, questions like what are the best ways that a bank can escape regulatory constraints, like capital adequacy ratios or other liquidity constraints. What are the actual balance sheet operations? What's the menu of choices that they have? And similarly, what are the choices that they can use to optimize their profitability under those constraints? So, when they have some space, what's going to be the most profit optimal thing for them to do? And so this calculator, automatically calculates for you things like reserve ratio, capital adequacy ratio, liquidity coverage ratio, net stable coverage ratio, risk-weighted assets, and lending capacity for different scenarios. And like I said, Sasha's going to show you how useful we think that is. But I just wanted to step back because I was thinking about it this morning and realized, like, wow, there's a really deep MoneyView pedigree to this tool and to this collaboration that Sasha and I have been working on. So just I always like to give credit to people who've inspired me in research. And so just to start off here, we've got Jay, who when I first came into studying monetary systems, which is my focus, and in particular, my focus is on the social, economic, and ecological impacts of monetary system designs. When I came into YSI, Jay is the one who welcomed me into YSI and introduced me to the MoneyView group and the MoneyView Symposium and really the MoneyView idea, and said you have to do this MOOC by Dr. Merling, and I started it a couple of times. It was so rich. It was I kind of was intimidated by how much there was to learn. And so I want to give Alex credit for when I finally kind of committed and got going, it was because he was kicking off his reading group. And so thank you, Alex, for that. I just want to say for folks who maybe are watching this, who aren't familiar with the MoneyView, that this is really practical knowledge. In 2023, when the money supply was suddenly dropping by 4.5% in the U.S., I was reading all these articles about why it was happening, and they were conflicting reports and reports that would just say it could be this, could be that, could be this other thing, with no precision. And I was able to use what I'd learned about balance sheet accounting to basically identify, there's these specific things that could be causing this from an accounting perspective. And I gave if you're interested in my answer to the question, I gave a presentation at the American Monetary Institute conference in 2023 about it. But it's something that I would never have been able to do if it wasn't for the fact that this group got me started on paying attention to balance sheets, understanding balance sheets, and collecting balance sheets. So I actually now have an index of over 100, I think it is, published representations of bank and central bank balance sheet transactions. And that has been invaluable to me. It was invaluable to me when I was trying to answer that 4.5% question. And so I offer that as something that may be of use to other folks. In terms of trying to answer that 4.5% question, I realized that I actually needed to create an index into my index, which I now call the monetary crosswalk. And it's just a matrix that maps all the different balance sheet operations for banks and central banks that can affect the money supply. And anyhow, again, none of this would have happened without the money view. I wouldn't have understood a single thing about balance sheets. I would never have understood why it's so important to pay attention to them, to track them, to learn how they work. And so just again, on some appreciations, I've had the benefit of Benji Whitehurst, who's at here where I am, at an MBA program to collaborate with. I think you all know Borja Clavero. He contributed some really nice thinking on payments and bank balance sheets. Martin van der Linden did the first collection of balance sheet representations that I'd ever seen that inspired the index. And Dr. Wang, who I saw on here yesterday, I actually forgot to check and see if he's on there here right now. But he's actually the one who inspired the matrix because of a table that he'd created. So when I was on the Money View Symposium last year, I was asking in the chat a question, which is, why exactly do banks need and want deposits, given that they don't need them to make loans, right? And, you know, when you look in the books, the standard answer is always that they need it to create space under the reserve requirement. And the reality is that they're, you know, the largest currencies in the world are operating in regulatory contexts that don't even have reserve requirements anymore. And yet banks are still trying to get, you know, deposits, and they're still paying for deposits minimally. But so I wanted an answer to the question that was really precise, you know, that had all the nuance that you can get when you analyze balance sheets. So I was working on that, and Sasha expressed interest in it in the chat last year. And so we ended up getting together on Zoom, and in that I was showing him these accounting games that I do. Again, would never have been doing this if I hadn't learned about balance sheet accounting from the Money View and from this community. So I had these spreadsheets where I worked through different scenarios, and I was showing him what I was doing with the deposits and reserves, but then also this capital adequacy scenarios game. And Sasha was like, wow, let's work more with that. So that's how we ended up turning what I was doing in the balance sheet with these games into a tool that we're looking forward to offering back to the community today. And I'll let Sasha take it from there.
Thanks, Sam. Okay, let me, can I share my screen? Okay, I can. Just give me 1 second. All right, so let's start with this. Here you have a balance sheet that should not be very difficult to get familiar with. So we have a bank, and the bank has 25 in reserve, and then among other assets, it has this safe corporate loan, a risky corporate loan, security, and like a safe security, let's say, and a risky security, each to the value of 25. And then it has deposits to 100. And obviously the equity then ends up being, we are going to be writing equity here, 25. So this bank, if we take a look at it, is going to be constrained in terms of reserve ratio and capital adequacy ratio if we set them at 25 and 5 and 11, which is what we did. And that's, you know, could be arbitrary. Capital adequacy ratio is somewhere there. Reserve ratios requirements are very different depending where you look. And then we have a couple of other things that we wanted to kind of assess. Two are the unweighted assets, risk assets, and risk-weighted assets of this bank. And then we have these two capital adequacy ratio lending capacity and reserve ratio lending capacity. So assuming that these are the ratios, 12 for the 11 for the capital adequacy. Here we have a little bit more than 11, so we end up having a little bit of space for lending. Let's think of it that way in terms of creating deposits and taking on some assets. And then we also included these three measures. They're, I guess, much more problematic from a money view standpoint, but we wanted to have this as well, which are these two: liquidity coverage and net stable coverage ratio. These are generally the ratios that are going to be looked at when the bank is borrowing in the interbank market or in the repo market. And so we said, we want to know which one is lower of the two, and typically, and we want to see what's going to happen with that as well, as bank engages in all kinds of operations.
So, quick question, sorry.
Yeah.
NSCR, is it the same as net stable funding ratio, or is it the new name or different?
Stable coverage. Yeah, I think it's the same thing. I think it's the same.
Okay. Yeah, I haven't followed it. This was new. Like, okay. Sorry.
So yeah, I saw both names in fact for this. So okay. And then just to give you a little bit more context, we have risk weights for these assets here, and we have interest on them. Typically, that would be priced into them. We didn't want to make this very complicated, so we assumed the same maturity. Obviously, not very realistic, but anyway, it's fine. And we assume that the Fed funds rate is going to be 4%. And that the pricing is risk-based. Okay, these are again simplifications that could be criticized from a money view standpoint very easily, but we wanted to kind of start working with it. And now the question for you guys, and I would love to get some responses here. So if you have a bank like this, right? So the bank is constrained, extremely constrained, if not completely constrained in terms of its capacity to lend, to do anything really. What should the bank do? Right. This is the question on how much of expertise in money and banking have we acquired after all these years. What are the things that the bank should go for? And this relates to this question that Sam brought up, which is, attracting deposits. Is it really that the bank should try to attract deposits in order to get out of this situation? That would be one question. Another question that this exercise is going to answer or help with is, how do reserve ratio requirement and capital adequacy ratio compare in terms of the incentives that they create for a bank if we look at its balance sheet in this gross format? Obviously, there is a lot of ink that's been spilled on this question in terms of generally comparing these two ratios, but they haven't been done as much, these considerations, from like a full-on kind of balance sheet standpoint or a money view standpoint. Correct me if I'm wrong. There might be something I'm overlooking here. So, and then there is a general question which should be of interest, which is, as Sam said, there are systems that hold on to reserve ratio requirement. There are systems that do not. Typically, almost all the modern monetary systems hold on to capital adequacy ratio. So we have worlds where these incentives are going to be very different depending on what's in place in terms of rules. Okay, so now the menu, and if someone wants to speak out, with the iPad don't get to see what's going on in the chat. Maybe Sam can bring things up if they show up in the chat, or you guys can just unmute yourself. But I will just give you a sense of what we wanted to consider here, and this should be also quite straightforward in the sense that these are the things that come to mind when a bank is in this kind of constrained position. So first, we obviously have issuance of securities, bonds, and equity. Now, once we start from a very known starting point among us, which is that banks create deposits when they do these things, when they lend, right? When they obtain assets, it becomes very important whether the bonds that banks issue on their liability side are obtained by depositors or by clients of other banks that are not their depositors. And then we have an interbank payment happening. So we have bonds and equity issuance. Then we have liquidation of assets. We can liquidate safe assets. We can liquidate risky assets, again, both with our depositors and with clients of other banks. And then we have a question of whether there is going to be a discount, since we are potentially liquidating at a time that is not conducive for us. And then swapping high risk for low risk assets. Maybe we can do that at face value. We don't lose value on the high risk asset that we are swapping. We get the same amount of value in low risk assets. Or we have to take a large discount there. How about paying a dividend to the depositors of our own bank or other banks' depositors? How about buying back our own shares? And finally, we also wanted to consider a couple of things that could be happening. There are obviously many more that could be happening without the will of the bank, but we wanted to look at mark-to-market appreciation and depreciation of different kinds of assets. So it would be great if we could have a little bit of a chat over this before we show you what we came up with in answering this. Yeah, if anyone wants to say something, this would be the time.
Did you want people to pick one of
I
these?
mean, if there is any response, both written or anyone wants to unmute and say something about this at this point, or whether it's clear.
One quick comment. You know, why the initial question? Why would they want deposits from depositors? There, I think, at least later on, maybe not for this first exercise, but it's, I think, important to think about what kind of deposits.
Right.
So like for normal banking or commercial banking, distributed within the limits of deposit guarantee versus like one banker or real estate guy told me, you know, there's a problem when you own a bank in Luxembourg and suddenly some oligarch comes with 100 million euros to deposit there. You know, so it's not even only quantity or how the quantity is distributed, but it's also some kind of quality of deposits. But I'm complicating, but I just wanted to throw it out.
Absolutely legitimate question. I mean, I guess we wanted to go with this in a very simple way. So domestic deposits and just, you know, without this consideration of the deposit insurance, right? Just simply domestic on-demand deposits. And the reason why we bring deposits up is because obviously in the you know, what we could call the banking ideology, banks are obtaining deposits in order to lend them. This should be the way out, right? This should be the typical way out. This should be the preferred way out if that theory holds. Now, we all know that this theory doesn't hold, but then, you know, maybe that makes it even more interesting to consider the question, what happens if the deposits are coming in?
Sasha, can you just preview briefly the menu that's the output? I know you want people to guess and fill in the pieces, but I think it would be useful for them to just see kind of the
I wanna do one more thing before that. I want to do one small thing before we go into that. So I want to give you the methodology as it's going to work out. So let's take two operations of a bank, of this bank, simpler or you know, more standard things. So let's have this bank lend to a corporation. So this kind of safe loan, which has a low risk weight of 80%, and you know, just how we write this, obviously the loan is going to show up on the asset side, the deposit is going to show up on the liability side. And so what we do then, we get this little calculator, as Sam calls it, to work, and we see what ended up happening with each of these parameters, right? So we see what happens with the reserve ratio requirement, reserve ratio of the bank, it's going to drop. We see what happens, obviously, since no reserve came in and some new deposits have been issued. What's going to happen to capital adequacy ratio? That's going to depend on how equity is going to respond to these risk-weighted assets here. And then we also look at the capacity to lend based on these two constraints. And we also look at this funding liquidity thought of in terms of these ratios, which is obviously maybe the most problematic piece of this analysis. And if a bank ends up lending on a safe loan, we see here what happens, right? So the bank is going to be dropping in terms of both its reserve ratio and capital adequacy. It's going to be, and even if this is a pretty safe form of lending, right? So to an outside customer, it's not interbank lending, which is obviously safer. But as long as we are dealing with a typical bank loan where deposit is being created. And then if we look at liquidity according to these parameters, we are also going to have issues there as well. And then let's take a look at the repayment, right? So now, and here again, let's exclude interest or any of which loan is exactly being repaid and what was initially issued. Just let's take a look at the initial balance sheet, and let's say there was this safe corporate loan at 25, and that's how much deposit we are now going to cancel out as it's being repaid. And we see obviously things going in the opposite direction, right? So as things get repaid, all of these things go up. The bank is in a better position. So, okay, if there are no comments at this point, I'm going to show you what we ended up having. And then in the background of this...
hey, Sasha.
Yeah.
So Michael and I have our hands up, and Michael was first.
Please. I don't see this, so you guys just need to talk and stop. Yeah.
Sorry. I'll just a couple quick comments. One is this is like what I do at my day job, which is just have spreadsheets and play with exactly this type of problem to try to come up with a solution. One thing I would say is like that there's always like paying attention to like the yields on some of this stuff does make a difference, because you're talking about like composition changes, right? How do we change the composition of our assets, say, to bring us within a better capital ratio? Changing composition of our deposits. I was thinking even back to like the list of menu of options. I was like, well, usually when I've played with this or we do this, you attract deposits, but you're not just thinking about deposits, you're thinking about relationships, like long-term core relationships, and then the value that those relationships bring you. So that's like one reason why the bank is going to want to do this a lot of times, especially too, if you think about the type of relationship, right? So you have the oligarch who gives you $100 million, or you get a hospital and the hospital is doing like, 100,000 transactions a day, and now you're facilitating the payment system. Now you're earning additional revenue. So there's like revenue attached to the deposits in terms of facilitating what's going on there. And then, I get those are my comments, I guess. Basically, like this is what I've been doing for like 10 years, I guess. And you're just like looking at composition and then a core business. I always think like too, whenever you come up against capital and liquidity constraints, it's trying to refocus the bank onto its core business, because sometimes, like say the risky assets, like security assets, if you're bonds of some sort, you have to ask yourself how important is this to our core function? We've developed this huge credit department in the loan area to do all this underwriting. But if we're out buying bonds and they're really risky bonds, how well are we doing the underwriting of these bonds? We're usually getting dinged worse on our capital relative to what we would with loans, and they're not core customers, which core customers bring long-term relationships, long-term, they're going to be repeatedly paying off and renewing new loan relationships versus the bonds like a one-time deal. So these are always, when you hit constraints, in my experience, it's like, let's refocus on core business and how do we try to configure our liabilities and assets to be more focused on the core business. And then to the capital issue, you can also like constrain growth in order to like accrue earnings, right? And eventually you can earn your way out of the capital constraint problem if you also just do something of that sort.
Right. Thanks for this. I mean, I guess ultimately we are here to learn from you. this was just our kind of very academic attempt to tackle this and think on a more systemic level what that means. I guess maybe just turning the story around rather than thinking from the bank standpoint as such, rather thinking about from the standpoint of these rules, right? What do rules incentivize? Looking at different systems of rules related to reserve ratio and capital adequacy ratio around the world, and what do they get banks to do more. But again, maybe we also made a lot of mistakes here, and it would be great if you point us towards them.
I don't know if you made any mistakes. I thought when I saw, I was like, oh, I love this. This is what I do.
Right.
But Michael, we did coming to this thinking we're going to learn a lot from the audience, and just one of the things that we were talking about as we were doing this is that in the banking industry, there must be a tool like this already. There must be a menu that people are operating from. And so if you have what that looks like, we would love to see that and
to see the real thing.
Yeah.
Oh, that looks very similar. A lot of it's like, it looks very similar actually, unless you, because the other, I guess, with this is like, this is point in time ratios as opposed to a dynamic across time. So that would be like the one thing where like I used to do, my role has shifted, and I've gone more exclusively to just interest rate risk modeling with some of these the holy grail for risk management in banks is that everything's integrated into one model where you're doing liquidity, interest rate risk, capital, and so forth. And that is like really, really hard to do well. But as the organization that I've worked with has grown, my role has gotten more siloed to just interest rate risk and doing dynamic balance sheets from that, and then trying to do some sort of overlay to do some of these assumptions about what is the risk composition of my loan book, what does it look like in 12 months and 24 months, which is not going to be the same as today. And so then you have to do some overlays to do the exact same types of calculations. But this is good. I mean, we do a lot of static analysis like this, and you're just gaming out scenarios, right? Like options. If we pursue this, what would this look like, and so forth. And this is very similar to what any bank would have.
We had another comment, if I'm not wrong.
Yeah, I'm gonna risk saying some things that are obvious, but when you ask the initial question, like why do banks want to attract deposits, we can break that into two questions, which is why do banks want to attract liabilities, and then why do they want those liabilities to be in the form of deposits? Liabilities, of course, fund assets, right? And that's true regardless of whether you have any capital or capital requirements or reserve requirements or anything like that. So attracting a liability means a cash inflow. Repaying the liability means a cash outflow. Expanding your balance sheet on the liability side means you can expand it on the asset side. So you'd kind of want to do that if you feel like you can make some money on an interest rate spread or something like that. Now, in terms of deposits in particular, as a liability, they're cheap funding, of course. And retail deposits in particular are not going to necessarily have a high risk of being withdrawn all at once, as compared to something like wholesale money market funding or something like that, which is more hot money. So you could maybe have more stable funding with retail deposits in expectation, even though kind of hypothetically they could all be withdrawn at once. I guess I just wanted to kind of establish all of these things that maybe we already know.
Right.
Yeah.
I mean, I guess my initial reaction to this, and I guess it's something we can discuss more, is I feel like when we simply say this, right, that attracting creating liabilities is a way to fund assets, it's kind of hiding more than it is showing, in at least to me, right? It's not untrue, right, in the kind of formal sense, but I feel ultimately we can issue deposits when we lend, right? And issuing deposits when we lend versus attracting deposits, I guess yeah, those two are obviously very different, right? In our mind, and I guess
Are they?
that difference, in the sense that,
you're
right,
attracting
if you deposit money with a bank, right, it will, you know, the bank will probably get reserve, I guess, if you're depositing money from your deposit account at another bank, right?
Yeah.
And that way the deposit is going to fund that reserve that you're going to get, while if bank lends to you, there will be a plus deposit on the bank's liability side as well, but on the asset side won't be a reserve, rather it will be a loan, right?
Well, you could just say that you attracted the reserve and lent it out at the same time or something like that. I mean, it's still kind of the same thing, right?
It's the composition, right? I think it's like, if you think of banking in the aggregate and you just consolidate everybody, then you would just say, well, loans create deposits, and then that's like the end of the game, right? But then when you split out to individual banks, and then that's where it's like, oh, there's a rate. What you just said, like, are you attracting deposits, or are you attracting reserves? You're really trying to attract reserves when you're trying to attract deposits to in a short term, this like type of situation you are.
You're not trying to attract reserves. You're trying to attract a profitable balance sheet position. You're trying to attract an opportunity to expand your balance sheet on both sides, right?
Yeah.
I want to
But
jump
what,
in.
but what gives you that possibility, right? Is it the reserve that gives you that possibility? Is it simply the deposit liability that you're adding? I would say definitely not simply a deposit liability that you're adding, right?
Well, the cash flows and the
I wanna
reserves
jump
can be
in.
notional, right? If you're expanding your balance sheet on both sides, right? They don't really happen. They don't really exist. What matters is the balance sheet expansion, and that the holding the asset is more profitable than what you have to pay to, you know, have the liability on your balance sheet.
Hey guys, I want to
Anyway,
jump
I'm
into this, because I actually, that question that I mentioned is a question that I was raising last year in the chat, and I actually worked pretty hard on a fairly precise answer to that, and that's not actually what we were intending to present today, or discuss. We just really wanted to present the tool and then allow folks to use it as you like. And in fact, what really prompted this whole focus on like, oh, reserve ratio regimes versus capital adequacy ratio regimes was that I was showing Sasha the calculator games that I was doing, the accounting games, and one of the sheets was capital adequacy ratio scenarios, and he was surprised that, oh, wait a minute, like there are times where the reserve ratio and the capital adequacy ratio are not moving the same way. And, you know, an assumption kind of in I think, which is true for many macroeconomists, is that, oh, you know, reserve ratio, capital adequacy ratio, they pretty much do the same thing. But they actually are quite different from the balance sheet perspective. And there are times when they don't move together. And there are times when one moves more than the other, and so on. And so we decided to kind of focus on that. And so we didn't actually, he and I did not prepare for you the presentation about the precise answer to deposit attraction.
No, but I mean, I think in fact the tool does have something to say about this. So let's take a look at the responses for a minute here. So for example, if we look at these operations that would be based on issuing liabilities, if I can open the calculator here and show you exactly how it looks in terms of the numbers, but the answer is that in all of these, if we take a look at these possibilities of issuing bonds, issuing equity, or attracting deposits, it's going to be best for the bank if it's capable of issuing equity that will be purchased by the depositor of other banks. This was what came up from using the calculator in the way we explained, right? It's better than getting the deposits, and it's better both for your reserve ratio requirement. It's better for your capital adequacy ratio, and it's better for your funding liquidity thought in the way we described. So that's, I guess, especially in the context of what we just discussed, something that might be interesting to think about. If we look at the liquidation of assets, and we look at the safe assets with your own depositors or with non-depositors, with the discount and without, obviously with the discount, this is going to be pretty bad. It's going to be pretty bad with the capital adequacy ratio, not necessarily with the reserve ratio requirement. So if that's what the bank has a problem with, it it will still improve the reserve ratio requirement for the bank. And if obviously if you're liquidating without the discount, then it's going to be better if we take a look at, if you consider both of the rules, it will be better to do that with non-depositors than with depositors.
Sasha,
I don't.
Quick question: Are you
yeah.
showing your screen, or are you wanting to show your
Am
screen?
I not showing my screen anymore?
I see
No.
your screen. I see it.
Oh,
Okay.
you do?
Yeah. Okay. Good. Because it tells me that I'm broadcasting it yet still.
Sorry about that.
Okay. So liquidate risky assets. Obviously, with the discount, it's bad. Again, it's bad mainly for the capital adequacy, not so much, not necessarily for the reserve ratio requirement. And then it becomes a little bit more complicated if you look at own depositors versus non-depositors. It will be better for capital adequacy ratio to liquidate risky assets with own depositors, while it will be better for reserve ratio requirement to do it with non-depositors, for example. And then again, we can pull out the full analysis for this. And then I guess another bit that was interesting, obviously, and I think this is what Michael was also mentioned, is swapping obviously higher risk for lower risk assets. And let's say you can do that at face value, which is obviously unrealistic in most of the cases, and we see how this looks, right? So in reserve ratio requirement terms, this doesn't do much. If you can do that at face value, then you're good in terms of your capital adequacy ratio. But the discount might make it worse for you if you end up doing that. It's not going to do much for your liquidity in those terms ultimately. Paying out the dividend. So this is something that Sam was very interested in, and obviously, what's going to happen if you pay out the dividend? It's going to be bad for both reserve ratio requirement and capital adequacy. Never mind whom you're paying the dividend to, and buying back shares again, and not to the same account. Even if the size of the dividend is equal, it won't be equally strong, the effect on these two types of cases. And ultimately, if you look at these depreciations and appreciations of assets, obviously appreciations are good. They do not matter for the reserve ratio requirement, obviously, because they do not do anything with reserve or deposits, but they are going to have a positive effect on capital adequacy, and obviously more positive if we are discussing the safe asset appreciation than a risky asset appreciation, because risky asset appreciation will add risk weight. Yeah. So okay, I'm gonna stop sharing my screen, or I can continue sharing a bit. But this is basically what we wanted to show you. And as Sam said, mainly for the moment, it's a very simple tool, but we hope it opens up this discussion, and then possibly it would be complicated, and help us think of these things in differentiated, because that's, I guess, the bottom line for us to see how these work differently and affect balance sheets differently. All right, I'll stop sharing my screen, and if you guys want to see it more, I'll come back to it.
See, Perry has his hand up.
Oh yeah, please.
Yes. So this is very interesting. I mean, there's been some chat about, creating some easier balance sheet platform or something. So this is the first step maybe in thinking about that. The 3 points. Okay. One, from a money view point of view, it might be you're aware of this, but just to highlight it for the conversation, that there's two issues. Okay, one is liquidity and one is solvency, and in a certain sense, that's what you're getting at with this reserve ratio versus the capital adequacy ratio. And we, the capital adequacy ratio, we always say, solvency is an accounting fiction and liquidity is a market fact. So where is the danger in what could destroy you as a bank? Is solvency not so much, liquidity most definitely. So that you're treating all of these like constraints, like this is a linear programming problem, and they're all the same. They're all the same constraints, and I want to say they're qualitatively maybe not the same. First, second point, what you're in the background of all of this is this phenomenon of flux and reflux. Okay, it's true that banks can expand their balance sheet by writing, just swapping IOUs with a customer. Okay, the question is whether those deposits will be sticky or not. Whether to so let's now distinguish two things. One part of that question is, does society as a whole, does the portfolio choice of society as a whole want to hold more money type assets or not? Okay. And then the second question is, how much of that societal portfolio preference can my bank attract? So those are separate questions. And because you're thinking about this from the point of view of an individual bank, you kind of mix up those two levels, that you want to ask yourself, if, so maybe I'll say that again. So it's a macro question versus a micro question, that and Michael was getting at this about think about the system as a whole. Yes, if all banks are expanding their balance sheets, doing the same thing, then the question is, in what form do wealth holders want to hold their wealth? And how much of that are they willing to hold in money form, i.e. deposits? How much of this do they want to hold in capital form? And if they want to hold it in capital form, then they're going to be very happy to take those risky assets off your balance sheet. You can sell it. You can sell it to them. So the notion that this is a choice variable of the bank, okay, is, I guess, what I want to put a little bit up for question, because there's somebody on the other side who has to be willing to do this transaction, and that's going to show up. That's going to show up in price too. So and to distinguish this micro versus macro, when you talk about other people's depositors and my own depositors, this is really about competition, between different banks for whatever society is doing. Okay, that is a constraint for the entire banking industry. Okay, but then you're competing with other banks for what part of that portfolio that society is willing to hold, am I going to get in my bank? So that's sort of moving from high, down. So that would be my framing about this.
Yeah, that makes total sense, in the sense that this was just a very kind of simplistic, like kind of more formalized quantitative tool, and obviously all of this is in the background, and here we, maybe cherry pick and represent things in a very, in a dangerously simplified manner, right? And exclude like very important variables that are going to affect this. But yeah, it was just a kind of a start, and just, I guess maybe in the way we present it, it can appear as if we want to make kind of more ambitious conclusions about what works and what doesn't. But I guess for the moment, it's more just to say, okay, if you look at the balance sheet, this is what happens if these operations take place. Now, whether they're going to take place, which of them are going to take place, what are going to be exactly the quantitative relationships that are going to be implied, all of that is fully open, and we didn't really touch on it at all. So
and that's fine. Let me be clear about that. That I think that's the beginning of wisdom, is to think about what are the initial consequences. But then moving beyond that, you need to realize the bank's balance sheet is not under its own control. It's not entirely under its own control. That other people are doing things, outside. And the when we're both involved in teaching balance sheets to students, and so I think this is a very good teaching tool to make people like think in balance sheets. You have to be able to think in balance sheets before you can appreciate the higher order, issues that are involved, flux and reflux, and all of that stuff. And they can't do that until they can think in balance sheets to begin with, and until they can distinguish issues of solvency from issues of liquidity. Until all of that is a prerequisite for actually thinking clearly about this at the level of macroeconomics. I always think of the money view, in fact, as macroeconomics. It's macroeconomics because it's system dynamics that are driving asset prices that are, but it's a system made up of individual little balance sheets, and lots of them. So how do you move from micro to macro in a sensible way? And mostly you're doing micro here because you're thinking about an individual bank. Okay. And all I'm saying is, embedding that in a system, and appreciating that agents have some agency, but they also have some constraints. The constraints you're focusing on here are regulatory constraints, I guess, capital adequacy ratio, stuff like that. And so one other purpose of an exercise like this might be to ask yourself, do we have, are our regulatory apparatus, is it doing what we want it to do? Is it good regulatory apparatus? Of course, it's evolving over time, as we know. What are we into, Basel IV now? And so obviously it's not doing what we want to do because we keep updating it. But why not? And I think why not might be that Basel I kind of began with the idea that if we get enough capital into the banks, everything's going to be fine.
Right.
And that turned out to not be true. That turned out to be misunderstanding the nature of banking. And so we're gradually moving to paying attention a little bit to, survival constraints and the settlement constraints and things like that. And Basel IV is much farther along than, but I'm not sure. I'm not sure at all. I mean, I haven't looked at it that closely, but it seems to me there should be implications of the money view for optimal regulatory policy. And so this kind of exercise helps to build intuition about that too. That's unfinished business, just to signal to everyone on the call that what kind of regulation is implied by a money view lens. We haven't really talked about that, but I think this tool helps you, in fact, start to think about that in an organized way, disciplined way.
Thanks, Barry.
Can I say something?
I think Marianne was next.
Oh, right, okay.
I think that Michael was before me, so Michael, go ahead, and I will follow up here.
All right, I might be just actually restating what Perry said real quick, but like I have three thoughts on this. One is like what you highlight about how there's like the trade-offs to the various decisions where everything doesn't go in the same direction is like something that's like I've confronted a lot. And then there's always a question of like, what do we actually want to prioritize? You can't make everything work for you perfectly, so you need to prioritize some of these from a pragmatic standpoint. And then there is like, you don't control everything, and this is I think back to Perry, like the way that the bank interactions with you don't control everything is the profitability of all your actions. So like say you even want to sell a risky asset, but nobody wants to buy it at a price that's acceptable to you. Right. This is all put off. And where you on the sheet you highlighted that like issuing equity is the most beneficial. I was like, well, the constraint there is what's this going to do to my return on equity as a bank, right? So there's another constraint that's not on there in regards to the profitability of all your actions and how that and that you don't control it exactly, right? Like you're unless you're a price maker, but we're usually price taker,
right?
On the third, I was going to say too, is like, especially with the liquidity, one thing I've always struggled with is we create a lot of these ratios and the regulatory apparatus really focuses on them, but there's so much, and to the point of like solvency or liquidity issues is what really kills you. But you don't, there's always like a huge element of uncertainty, right? Like, what is an adequate level of reserves to hold against a potential loss of deposits, and over what period of time will those deposits go away, and what are my menu of options for backfilling? So like another thing that I would add to something like what you have there is like, what are my off balance sheet sources of liquidity that I have available that I could refill in a crisis type situation? But I've found like just as like more ratios don't always help with liquidity management, because there's always just a huge uncertainty of like, well, 5 billion went out the door yesterday. Nobody would have thought that, and we're a $20 billion bank, so now that's a huge problem. And so there's always like, yeah, there's meeting regulatory constraints, but then there's like, what do I really think is going to happen? What is my cautionary level that I need to hold against this? And so that's like maybe either above and beyond regulatory or wherever it rests, but that's something that management has to struggle with, is like, what is my customer base? This is the whole sticky deposit. The types of deposit composition matters, because it's how sticky are they, and then how much do I think I'm actually at risk of, flight happening, which is a harder to quantify exercise.
Right. Thanks, Michael.
Hey, thank you for the presentation. I have like one or maybe 2 points, and there is a number of different requirements. So you just like pick up 2 particular one. So even on the capital side or on the liability side, there are regulation as like leverage ratio, capital adequacy ratio, minimal ratio on eligible liabilities, and so on. And all of these have different consequences when there are breach, basically. So I think that you need to take into the consideration also the results of the breaching the particular requirements. So I haven't seen it in the presentation mentioned, so that's one thing that came up to my mind, as this is my daily job to think about such a stuff. Thank you.
Fully agreed. We just started. That would be the answer. We would want to include more, but this was just to start it off.
Thank you again for the presentation. I looked at the liquidity, if you look at the reserve ratio or the capital ratio, just thinking about liquidity risk and solvency risk. And then I applied it to what Perry was mentioning, trying to say, if I understood well, that the liquidity is the big risk. But I refer to a reading we had lately, which is called Failing Banks by Emil Werner, which showed that basically banks fall mostly from solvency and not liquidity, and sort of looks at the claim of Diamond Divic, which didn't really work. So I was wondering, maybe it's not exactly for this, how this paper comes into the money view, where money view looks much more at liquidity as opposed to the solvency. Thank you.
Right. I think that's a great question. I mean, I think I guess this is my way of looking at it, and I'm sure Sam will have some other things to say here. As far as I'm concerned, this kind of comes into the story of MoneyView as like an additional tool in the balance sheet analysis, right? So I would say that if I want to do a balance sheet analysis of, for example, a foreign, like an exporter in my country earning dollars, bringing them into the country, depositing them with the bank, getting a domestic deposit, and then I want to work through the whole kind of set of consequences that's going to have with the central bank, with the banking system, and so on. I would like to have my bank balance sheet modeled fully to take into account all of these ratios and constraints that the bank is going to face, which obviously are not themselves like directly all concerned with liquidity. but then they will be part of the framework that the bank will have to consider when considering liquidity, right? And I guess that's the point, right? Like ultimately, we will want to see cash flows, and we will want to see effects on liquidity. But these pieces are going to be the kind of the context in which that is going to happen, a framing context that's going to determine to some extent how that's going to be happening.
Yeah, I would just add that a next step for this tool would absolutely be to add another bank to the calculator, so that you can see the implications of flows between the two. You know, the banking system is one big balance sheet, but a lot of the problems are when the banks don't cooperate and you have, you know, flows that are not being balanced by, you know, interbank lending or whatnot. And you know, to the question of deposits, what I actually have some scenarios that have two banks, and it was part of me trying to figure out what happens with deposit flows. And you know, it was quite interesting because it showed that a lot of what deposit flows is about competing for assets. Really, at the end of the day, your deposits are like hooks, fishing lines to like hook assets off of another bank's balance sheet. If you can attract that bank's deposits to you, and so on. Anyway, I think this is a next step, and I think Sasha and I would love for anyone who wants to go to the macro level of the banking system and add one or more banks to be done.
Yes, if I have the final hand, you already took one of my comments, like to add another bank. I mean, I love it. I love this stuff from the beginning, and it's like taking on some of both things we and Sasha have discussed, and also just from my thesis, my PhD thesis 10 years ago, when LCR, liquidity coverage ratio, and net stable funding ratio was like new into the regulatory framework. And one of my conclusion of that thesis was that we needed different measurements. So it's fascinating to see this, and I might be rephrasing part of what Perry was also saying. I think you should think of like two ways with this forward, or maybe one base thing and then two strands from it. One is educational tools, you know, how to use it in teaching. I had some applications once to do a interactive workbook for the MOOC, you know, for the course, so that the students could play with balance sheet interaction. And then so that's one strand, and then the other strand is to take this into the like Perry mentioned, the regulatory scenario game or planning or testing with the aim of even finding what else should be needed. So that's maybe the third step of the evolvement of I see this. I mean, one is to teach it, another is to test it on the real world regulatory thing, but then, you know, using the flaws or learning from it, yeah, but we discuss it later. But I just wanted to thank you guys for doing this fascinating stuff to see, and I look forward to read your Substack, Sam. I haven't followed this for a long time, but great work, fantastic to see. Thanks.
Thanks, Asger.